Conditions are deteriorating quickly in the Raleigh housing market for buyers and sellers as the Fed fights to tame inflation, and leading and lagging indicators are sending mixed signals on whether or not we're actually in a recession. And to make it worse, when you watch the latest videos on YouTube, all you see is the same old thing with Redfin and Realtor.com data and headlines that says the housing markets are crashing because rates are up and buyers disappear. So if you're someone that's actually planning to move to the Raleigh area, well, I made this video especially for you, so you can make an informed decision without wondering if you're overspending or worrying about being trapped at the top of the market. Hey, I'm Will Wofford, real estate broker with Berkshire Hathaway in Raleigh, North Carolina. And this channel is all about living in Raleigh, Raleigh real estate, and where to live. So if you haven't subscribed, go ahead and subscribe to the channel. And let's jump right into the video. Now, as I've said in previous videos, the Fed's decision to raise interest rates has sent about 20% of the buyers to the sidelines, which means the odds of selling a home for multiple offers has decreased to less than 50%. But believe me, I'm still seeing buyers compete for homes, and in some cases, it means you'll have to still put down a lot of due diligence money, offer a quick close, and offer well over list price if the home's correctly priced and it's in an area that's in high demand. And yes, I promise you, that's still happening, and location and price matter no matter what you see or read. So let me give you a little breakdown of how the Raleigh market is made up. And I want to clarify, when I say Raleigh, I'm actually referring to Wake County, which includes the Raleigh suburbs like Cary, Apex, Morrisville, Holly Springs, Fuquay, Varina, Garner, Knightdale, Wendell, Zebulon, Roseville, and of course Wake Forest. But it doesn't include Durham or Chapel Hill. Now those areas are actually in close proximity to Raleigh and would be viable options if you were considering the Raleigh area. But Durham and Chapel Hill are actually classified as the Durham-Chapel Hill metro area. So to make this more accurate, I will only give you stats for the Raleigh-Cary metro. So send me a message or leave me a comment if you have any questions about that, because the Durham-Chapel Hill metro is actually a great area. Don't get me wrong, I just want to give you a real sense of the Raleigh market. And the median sales price for a home in Raleigh is currently $420,000, which is based on actual data from my MLS as of the end of July. Homes priced $500,000 or less make up the largest percentage of the market at 45%, while homes $500,000 to $1 million make up 44% of the market. And I'll tell you, it's really only a matter of rounding that separates these two price points. Homes $1 million to $1.5 million are 6% of the market, and homes priced above $1.5 million represent the smallest segment at 5% of the market. So when you see everyone on YouTube talking about national markets or local markets, well, they're just really talking about the easy data that's on Redfin or Realtor.com that they have ready for you. But honestly, that doesn't tell you exactly what's going on. So let's dig a little deeper and let's take a look at the markets for each price point to see if we might have an oversupply problem that could or would potentially lead to more price reduction. Now, looking at homes priced $500,000 or less, there are 1,109 of them, which represents a 1 month supply of homes for sale at this price point. Digging a little deeper, 846 are resale homes and 262 are new construction homes. So there's less than a 1 month supply of resale homes at this price point, and about a month and a half of new construction homes for sale. Now here are two important leading indicators, and for these I'll only use resale homes because new construction homes are often sold before they're ever put on the market. First is the number of showings to pending, which are about 12 as of July, and the median days on market was 6 as of the end of July. And here are two very useful lagging indicators, again, only looking at resale homes. Percentage of original list price, which is also known as price to sales ratio, was 101.3, which means homes in this bracket sold for about 1.3% above list price, and median price per square foot was $227. Looking at that data from a 10-year perspective, I would conclude the $500,000 or less price point appears to be in good shape. And I'll show you how rates play into all this after we take a look at the next three price points. So bear with me. Now, looking at homes priced $500,000 to $1 million, and remember, this price point's a close second to the $500,000 or less price point because there are 1,101 homes in this price bracket versus 1,109 in the $500,000 or less price bracket. So that's only 8 less. But 1,101 represents a 2 month supply of homes for sale at this price point. Digging a little deeper, 606 are resale homes and 496 are new construction. So new construction makes up 45% of this price point, which translates to a 1.6 month supply of resale homes and a 2.7 month supply of new construction homes. The number of shows to pending are around 14, and the median days on market are about 6 for resale homes. Homes at this price point as of July were selling for 1.1% above the original list price and $238 per square foot. So again, with this price bracket, I think you'll have a hard time arguing that the market's showing signs of deterioration that would actually lead to a major crash. But let's keep on digging through the next 2 price points, and I think you'll have a pretty good understanding. All right, there are 149 homes priced between $1 million and $1.5 million, which represents 6% of the market and equates to a 2.6 month supply of homes for sale in this price bracket. Digging a little deeper, 86 of those homes are resale homes and 63 are new construction homes. So new construction represents about 42% of this price point, which translates to 2.4 months supply of resale homes and a 2.9 month supply of new construction homes. So here we're seeing new construction homes starting to creep up a little bit. The median number of showings till pending are 14, and the median days on market are 6. Homes at the $1 to $1.5 million price point sold on average for 0.5% above list price at an average price per square foot of $272. Now to me, the market still looks to be in pretty good shape, but please let me know in the comments what you think. And for the last segment, let's take a look at the luxury high-end market that's priced above $1.5 million and currently goes as high as $9 million. Now there are 114 homes in this group, which represents 5% of the market, and there's currently a 4.7 month supply. Ouch! Now digging a little deeper, 44 are resale and 70 are new construction. So new construction is actually 61% of this price point, which translates to a 2.8 month supply of resale homes, and get this, an 8.3 month supply of new construction homes. The number of showings to pending were again around 12 for resale homes, and the median days on market was 6. Homes sold on average at original list price, and get this, $377 per square foot. So I would say the high-end luxury market on the new construction side looks like a different story than the rest of the Raleigh real estate market. And there are more of these homes for sale than ever before, with an average list price of $2 million. So looking at that stat alone, I think it would be safe to assume the high-end luxury market for new construction will be the first to correct. But in order for that to happen, I think it'll take more than just mortgage rates moving up a couple of points. You see, Raleigh is an economic hotspot for jobs, and not just any jobs. Raleigh's seeing rapid growth in the tech sector as a result of the RTP, and it's really second only to Silicon Valley in tech jobs. And that's not all. There's currently a massive amount of commercial development that's already underway in the Raleigh area. And these commercial developments have been in the works for years and take tons of time to push through the city planning department, which includes all kinds of research and case studies that tie into the city of Raleigh's economic forecast for growth, transportation, and so much more. So what's occurring on the commercial side is about as real as it gets. And these recent studies conclude we have a ton of high-end apartments being built or recently completed, but we're about 45,000 short of what we're actually going to need in 2035. And the size and the scope of the developments happening right now in the commercial office space, apartments, and retail, well, that leads me to believe that Raleigh's job market and real estate market should be quite strong for a long time. And with that being said, I think for the new construction segment of the high-end luxury market to crash or fall apart, I think you need to see some of the big technology companies in the area lay off some of their highly paid employees, and we don't have any real indication that will happen. All we have is more tech companies moving here, and mortgage rates are up substantially from their low point ever since the Fed raised the Fed funds rate to combat inflation. So I really don't think we're talking about a financial meltdown like we saw in 2007, 2008 that comes with lots of foreclosures that saturates the market with lower prices, because rates were actually much higher than this in July of 2006. And that's not what led to the real estate crash. It was the inability of subprime borrowers to pay their mortgages, which ultimately unraveled on a massive scale as they packaged these mortgages inside mortgage-backed securities, which led to the collapse of our financial markets. Now, I think what we're seeing now was caused by a good old inflationary bubble. And unless the price of everything around you is going to fall. Like, for example, a 12-pack of Coke that now sells for $6 or $7, or the cost of everyday items like toothpaste or shampoo. These are unfortunately the effects of inflation, and I have yet to see the price of goods and services fall. Once they establish a new high, they tend to stay there and eventually go on to make new highs. In addition to inflation, since the last real estate meltdown, we've seen the emergence of a slew of new companies that position themselves to take advantage of the fallen mortgage rates and the rise of the internet as a 24/7 marketing tool since the launch of the iPhone in 2008. And I'm talking about companies that you know, like Zillow, Opendoor, and Redfin, and so on. These companies wanted you to believe computers and algorithms were better than realtors, and now they're paying the price. Here, I'll show you what I mean. In Wake County, you can see Zillow did all of their selling at the market peak for the year, and currently they show 0 actives or pendings under the Zillow name. So for Wake County, Zillow appears to have dodged a bullet, or they're holding properties and possibly intend on renting them out, but I'm not sure. But Opendoor, well, they're a different story altogether. Let's take a look at Opendoor sales for the year. Just on the list side, since they bought most of these homes to flip for a profit, there are actually currently 36 pending properties with, get this, 174 active listings in Wake County alone, and 149 of those listings are priced in the $500,000 price bracket or less, which represents 18% of the active resale market in that price bracket. And take a look at their closed sales for the year on listed properties. And think about this, the market was at an all-time high nationwide up until March of this year. And a good amount of those buyers had interest rate price locks. And I just want you to look at all the homes that closed below list price. Now, it's true their median list to sell was 99%, but as you can see, there were so many homes that sold well under list. And think about that for a moment and consider the 174 active listings that Opendoor has that will negatively affect 2 price brackets in the resale market when they eventually sell. And that's because Opendoor and all the other flippers out there bought these homes by marketing an all-cash offer with a no-hassle quick close to the seller, and it almost looks like they had no regard to what they were actually buying. After they closed on the properties, at least the ones I've shown, I honestly couldn't tell you that they'd done any repairs at all, and for the most part, they just increased the price by about $50,000 or so and waited a couple months to relist. Seriously. So while in 2007, 2008, we had banks loaning money to borrowers that lacked real credit, we now have publicly traded home flipping companies that use investor money to purchase real estate based on his estimate. And it's not just the companies I mentioned. There are more. But homes that have been well cared for in desirable locations will continue to increase in value. So I really hope this overview has given you a better understanding of the Raleigh market. And if you're considering a move to Raleigh and would like some help finding a home, I'd love to be a real estate resource of choice. Please feel free to reach out with a phone call, text, or email, and I'd be glad to help you. And I'll see you on the next one.